Welcome to the continuation of the stock market discussion, selling securities to the public. We'll deal with primarily the IPO process in this section. Again, this is Dr. J. Kent Gregory, and I'm using Fundamentals of Investments, ninth edition by McGraw-Hill, and that came out in 2020. So selling securities to the public. So to take a step back, with private equity, their goal path, if you will, is to invest in a private company, improve its performance, and then exit the business with a realized profit. So how do they do that? Well, one way to do that is to sell to another investor, but the preferred method is to sell to the general public. So this then implies an initial public offering on one of the stock exchanges. So the primary market, this is the market in which shares are first sold to investors, companies that issue new securities to raise money. The secondary market, this is the market in which previously issued securities are traded among investors. So investors are constantly appraising the values of a company by buying and selling shares issued by the company or companies. So if you think about it, the valuation of the company from a stock perspective or for a shareholder investment perspective or shareholder value perspective is constantly being adjusted based on the buying and selling. So in the primary market, you have the IPO, the initial public offering. This is when a company first offers stock for sale to the public. And typically the company is small and growing, but it needs capital for further expansion. So it's a successful company and it needs more money or it feels like it can gather more money for further expansion or profit. Then there's the SEO, and this is an acronym for Seasoned Equity Offering, which is also known as a secondary offering or a follow-on offering. So this occurs in two ways. One, a general cash offer. Securities are offered to the public on a first come. Sorry, that's a first come. So I'll write that first come, first served basis, and then a rights offer. Securities initially offered to existing owners, and then whatever is bought by the existing owners, assuming anything remains, is then sold out to the public. However, this is a rare type of offering in the United States, but it is common in other countries. So, how does an IPO actually happen? So, one of the best ways to look at that is the example from our book, Fundamentals of Investments. And this example is on page 140 of the ninth edition. So let's consider this situation or this scenario. You set up a privately held company with 100,000 shares of stock, all for $1 each. You bought 50 shares yourself, and 50,000 shares rather, yourself, and you sold the other 50,000 to friends and contacts out there, who, by buying that 50,000, essentially become venture capitalists. So over the years, maybe it's just been a couple of years, the company has succeeded, but you and the company need cash to expand operations. So you and the other shareholders in a meeting agree to take the company public. But you don't really know how to do that. So what you do is you hire an investment banking firm. And this investment banking firm or investment banking firms in general specialize in arranging finances for companies by finding investors, i.e. buyers, for newly issued securities, among other things that the investment banking firm does. So in this scenario, the investment banking firm suggests an issue of 4 million shares. So 2 million shares are distributed to the original shareholders, you and your friends and contacts, in exchange for the old shares. Then the investment banker agrees to underwrite, i.e. assume the risk of buying the newly issued securities from a company and reselling them to investors. The investment banker agrees to underwrite the stock issue by buying the other 2 million shares for $10 a share. So it's interesting. The value of the shares has gone up not only from $1 each, but to $10 each, and the number of shares has increased by 20-fold. And then by the 20-fold number is the 2 million that now has gone to the original shareholders. So your 50,000 shares is now 100,000 shares. I'm sorry, 1 million shares. And each share is worth $10 a share. So you went from an investment of $50,000 or a valuation of $50,000 to a valuation of $20 million. Something to think about. So when you've concluded this agreement, you have just sold half of the company for $20 million. So this is the $20 million coming from that investment banker. So your company can use this amount to expand operations. The investment banker will, as is typical, resell their 2 million shares on the primary market. And in this case, the banker thinks that they will sell for $11 a share. So they're going to make a profit of $1 per share on 2 million shares. So this is called the underwriter spread. So the underwriter spread is the compensation to the underwriter determined by the difference between the underwriter's buying price and the offering price. So typically underwriters will form a syndicate. So this is a union of other underwriters to share the risk and then help sell the issue of the securities. So rather than an underwriter going alone, he or she or it, if it's an institution, will band together with other underwriters to sell it. And that way they spread the risk. Of course, they're lessening the potential profit that they can get, but the risk is mitigated. And interestingly, this is just like Lloyd's of London for insurance, where some interesting insurance risks are undertaken by syndicates at Lloyd's of London. And that's a very brief and very simplistic way of looking at Lloyd's of London. There are two basic types of underwriting, and then there's a third that we will talk about in the next section. But the two basic types are firm commitment underwriting and then also best efforts underwriting. So under firm commitment underwriting, which is the most common type in the United States, the issuer sells the entire issue to the underwriter, who then attempts to resell the stocks. The underwriter's fee is the spread, and then should the new issue not sell for the offering price, the underwriter may end up lowering the price and will either have to eat the loss or take a lesser profit, even if it's the amount that they're able to sell it for is a little bit more than what they bought it for from you. So the issuer always receives the agreed upon price. Now, something to keep in mind. Risk is typically minimal because the price isn't set until the underwriters have gauged the market. Also, because the offering price typically isn't set until just before selling starts, the issuer doesn't really know what he, she, or its net proceeds will be until that moment. And then there's best efforts underwriting, which is very uncommon now. So the underwriter enters into an agreement and and part of that agreement is that he, she, or it, if it's a firm, sells as much of the issue as possible according to his, her, its best efforts. And again, it must be best efforts. But the underwriter can return any unsold shares to the issuer without financial responsibility. So that concludes much and just about everything that we're going to say about IPOs for the moment. The next thing that we'll talk about in the next section is Dutch auction underwriting, which is very rare, but this is what Google did. Uh, so we will talk about that in the next section. Thank you for joining me, and I hope you enjoyed this and learned a good bit. Thank you.